Hello, my name is Tiffany C. Wright, and today I'm here to talk to you about financing your business, to go over some of the options that are available to you to fund the growth of your business or to fund an acquisition. This particular presentation is targeted at medium-sized businesses, those with 20 to 50 million or more in annual revenues. For those with significantly smaller businesses, check back later and I'll have a presentation for you that discusses financing options for small businesses. If you want to know more about me and my background, I cover that briefly at the end. The first thing when it comes to financing your business is to take what is often perceived as an innovative approach by business owners. You must view your business as a separate, viable entity from yourself. Just like a stock or bond or real estate or any other asset out there, you need to view your business as a marketable asset. You need to view your business as a source of long-term wealth and as a creator of employment and jobs. You also need to view your company as a source of investment income for yourself and the other founders and for others who believe in the business, otherwise known as investors. Now, I'm not going to talk about bank debt here because everyone's aware of bank debt, but I do want to talk about the alternative debt options that exist. This just briefly covers some of the options that are available, such as asset-based lenders. These include receivable financing entities such as factoring companies and accounts receivable credit line providers. These also include equipment loan providers, which are typically industry-focused. These could be the actual equipment manufacturers or distributors, or it could be a third-party equipment financing entity. Any of these may provide lease options. Hard money lenders. There is a need for these. If you need money in a very short period of time and you have a viable asset, they can be a source for that financing. Hard money lenders are often maligned, but they do serve a definite need. Supplier or vendor financing or venture merchant banks round it out, and the latter typically serves retail or distribution companies. Now, for medium-sized businesses, equity sources include joint ventures, strategic investors, and strategic investors are a large corporation operating in your realm. That would be a suitable strategic investor. Hedge funds. Often people think of hedge funds as investing only in large corporations, typically in the public debt of those corporations. However, smaller companies can tap into hedge funds via something called PIPEs, which are private investments in public equities. I'll talk more about this in a different presentation. IPOs or initial public offerings. Yes, they are not as popular as they were in the past, but this option still exists. Private equity funds. Actually, those that serve the small to middle market have a lot of cash. They raised a lot of money before the market meltdown, and they typically have a 5 to 7 year distribution period. In addition, the number of companies they invest in has decreased due to lower performance as a result of the economic downturn, so private equity firms are still sitting on a lot of cash and have a lot of money to invest. And there's private placements and venture capital. What do investors want? And this is very important to keep in mind. Investors want a strong return. If it's a bank or similar low-risk entity, then they want a lower return like 8%. But if it's a higher risk entity, or if the company has an elevated risk profile, or they are investing in equity such as a private equity firm does, then they want a greater return like 40% or sometimes even higher. They need a clear payoff date and an exit strategy, typically within 3 to 7 years. But they need to know when they're going in, when they're going to get their money out. They are not interested in hanging out for 10, 15, or 20 years with no idea of when they're going to get their money back. They want to know in advance when they can expect a payout, and they prefer to have an option A and an option B in case plan A doesn't work out. A strong management team is vital. A strong management team can take a so-so company and make it great, but a mediocre management team can take a good company and drive it into the ground. Investors also want a base valuation of the company. You should know what your company is worth. The investors may value the company higher or lower, but if you have no idea what your company is worth, then you have no idea whether or not you are getting a good deal or a bad deal on the money the investors are putting in. And you need to have a plan to accomplish your goals. If you say you can double the size of your company in 3 to 5 years, then the investor asks, well, how do you plan to accomplish your goals? And you just say, that's not good. You lose all credibility. Blended debt or equity, also known as hybrid, typically comes from insurance companies or mezzanine or acquisition finance companies. And what that is debt at a higher interest rate than you would get at a bank with warrants or options attached to them. I'll go into what warrants and options are in another presentation later, but for now, just know that these exist. Now, the main thing when thinking about sources of financing is to be aware of how much money you need. That's why you'll see sources and uses of funds. How much do you need and for what? Because you may not actually have to go out to an official financing entity to find the funding. The funding may be available right there with your partners or your customers or whatever, depending on what you're trying to accomplish. If you're trying to enter a new market, you may be able to co-brand or co-market with someone else. You may be able to pool funds through a cooperative, or your customers may be able to assist through customer deposits and prepays. Or you may be able to spin off a portion of your company to your employees through an employee stock option plan, or an ESOP. There are economic development grants and bonds that exist to help companies grow, depending on the impact that company will make in the city or region in which the company is located. There's licensing, and there's the option to swap or barter. And again, I'll go into all of these in more details later. I just want to give you an overview of the options that are out there. Now, if you're looking at acquiring a company, remember, the financing comes from or is based on the entity that you are acquiring. So if that company is a significantly larger entity than your particular company, then that's fine, because whoever is providing the financing is not looking at your particular assets or your company's assets to pay the company back. In general, they want to make sure you have skin in the game, so they'll take a look at your assets or your company's assets. But they're mainly focused on the cash flow generated by the company you're acquiring being used to pay down the debt or to generate the expected return on equity. So the options that exist for acquisition financing include owner financing, supplier or vending financing, mezzanine financing, which is also called bridge financing, bank debt, private equity, or something called earnouts. Again, I'll talk more about these later. So to get started, here's my little pitch. I wrote a book called Solving the Capital Equation, Financing Solutions for Small Businesses, and it's available on Amazon. It actually does read very easily. It has really easy to follow case studies and examples, and is written the same way I'm speaking now. We're going to change the title. Yes, I have a BS in engineering and an MBA in finance, so I thought Solving the Capital Equation was a great name at the time, but it's actually not a good title. People think it's an economics or math book, but believe me, it doesn't read like that. It reads great. We've received great feedback on from people who buy the book. We also have an ebook, Help! I Need Money for My Business Now, and that's available online at www.smallbusinessfinancingresource.com. You can download that one immediately. Again, I said I'd give some background on myself. In the last 5 or 6 years, I've helped companies raise about $31 million in financing. I have an MBA in Finance and Entrepreneurial Management from the Wharton School of Business at the University of Pennsylvania. I bought a company, and I'm looking to buy more. I have started a couple of companies. I have served as the interim CEO, COO, and CFO of a number of businesses. I've served as an advisor to a number of CEOs, and I sit on the advisory board of a few small companies. So that's just a little bit of background about me. If you want to see more financing options, you can check out my blog at blog.smallbusinessgrowthcapital.com. There's the information. Thank you very much.